All right, so imagine this. What if you could pull more oil out of the ground and store CO2 at the same time? Sounds great, right? A perfect win-win. But does the math actually pencil out? Today, we're going to break down the high-stakes financials of CO2 Enhanced Oil Recovery. Okay, first things first. Let's get on the same page. What is this stuff? CO2 Enhanced Oil Recovery, or EOR for short. Well, the idea itself is actually pretty straightforward. Basically, you take captured carbon dioxide, you inject it into old oil wells, and that extra pressure, it helps force more oil up to the surface. Simple as that. And look, this isn't some sci-fi futuristic idea. People have been doing this for decades. But that's what makes the real question so interesting. And it's what we're digging into today. Is it a good business? You know, what's the bottom line? What are those tiny little margins that can make or break an entire project? So to get to the bottom of that, let's just treat it like any other business. We'll start with the balance sheet. And where do you always start with a balance sheet? The revenue. Let's see how these things actually make money. When it comes to the income side, it's about as simple as it gets, really. The main way, pretty much the only way, these projects bring in cash is by selling the oil they pump out. It's a one-to-one thing. Every single extra barrel they produce is money in the bank. Yeah, but here's the catch, and it is a huge one. That simple revenue stream, it's completely shackled to the wild roller coaster of global oil prices. I mean, when oil prices are high, you're golden. The profits can be absolutely massive. But when those prices crash, the whole business case for a project can just, poof, disappear. Literally overnight. Okay, so that's the money coming in. Now let's flip the coin and look at the other side of the ledger, the costs. What does it actually take to get one of these things up and running? So if you break down all the expenses, they pretty much fall into three big categories. You've got your initial capital investment, right? The big upfront cost. Then you have your regular day-to-day operations. And this is the big one, the cost of just getting the CO2. And wow, I mean, just look at that. One of these costs is not like the others. It completely dwarfs everything else. You got it. The single biggest line item, the biggest ongoing expense, is simply buying the CO2. I mean, getting it from industrial plants can set you back anywhere from $30 to $80 a ton. Think about that range. That's a massive swing, and it puts this huge cloud of uncertainty right at the core of the whole business model. And don't forget, that constant cost of CO2 is on top of the gigantic upfront investment you have to make. We're talking about building entire compression facilities, overhauling old wells, laying down miles and miles of pipeline, and putting in all sorts of complex monitoring gear. It's a staggering amount of money you have to sink into the ground before you see a single penny of revenue. Okay, so let's recap. We've got unpredictable revenue on one side and really, really high costs on the other. That sounds like a recipe for a tough business, right? So the question is, what are the wild cards? What are the things that can totally change the equation and push these projects into the black? Well, the first game changer is actually pretty simple. Just being really, really good at your job. I mean, operational efficiency is king here. A skilled team that knows what it's doing can squeeze way more oil out of the very same rock than a less experienced one. And every single drop of that extra oil, that's pure profit. It goes straight to the bottom line. And this right here, this visual, this perfectly captures the financial tug-of-war that's going on. On one side of the rope, you've got the wild, chaotic, up-and-down world of oil prices. But pulling on the other side, you've got this steady, powerful, anchoring force, government policy. Yeah, in the US, that big anchor is something called the 45Q tax credit. And honestly, it is a total game changer. What it does is give companies a credit up to $60 for every single ton of CO2 they lock away underground for good. So all of a sudden, you're not just in the oil business anymore, you're in the carbon storage business too. And that gives you a second stream of income that's way, way more predictable than the oil market. All right, let's pull all these threads together now. We've got the revenue, we've got the costs, we've got the wild cards. It's time for the final calculation on the business of CO2 EOR. So, at the end of the day, whether one of these projects works or not, all comes down to this really delicate balancing act. You've got these forces pushing you toward profitability. High oil prices, running a super efficient operation, and those awesome government incentives like 45Q. But you've also got these massive weights pulling you down. The crippling cost of the CO2 itself, the huge initial investment, and all the day-to-day expenses. Our project succeeds or fails right there. in the middle of that financial battlefield.
And that leaves us with one last big question to think about. Because this isn't really just about one company's profit and loss statement, right? This is about the future of energy. So as we look ahead, what's finally going to tip these scales for good? Is it going to be some amazing new technology that just slashes the costs? Or will it be a big policy move from governments that makes the business case a no-brainer? The answer to that? Well, that could change our entire energy system for years and years to come.